If you search the word Bond on Google, you will receive a wide range of James Bond images or 007. However, James Bond had nothing to do with our lesson today or make you learn better in finance. So you have to ask the right question. What is bond? A bond is a long-term promissory note issued by a business or governmental unit. If a business or government needs money, they will issue bonds. By issuing bonds, corporations can borrow at a lower interest rate than the rate available in banks. To understand this kind of fundraising, we have to take a closer look at bonds' 5 key characteristics. All bonds, except perpetual bond, must be redeemed at a future date, so they generally have a specific maturity date. When a bond matures, the bond issuer repays the investor the full face value of the bond. We also call it the par value. During the life of the bond, the issuer also pays a fixed number of dollars of interest or coupon payment. It can be paid at regular intervals during the term of the loan, typically every 6 months or 1 year. Most of the time, the company issuing the bond will set this interest rate. When interest rates in the economy fall substantially below the coupon rate, the issuing corporation will typically call a bond. A call provision then gives the issuers the right to redeem the bonds prior to maturity under specified terms, usually at a price greater than the maturity value. The difference is a call premium. Moreover, the issuing corporation often buys back a percentage of the issue each year to facilitate its orderly retirement. We call that provision a sinking fund. Now, imagine you are an investor. You are hesitating whether to invest in stock or bond. Which one is a suitable investment for a portfolio? And for sure, what you have to do then is to calculate the bond's value. According to key characteristics mentioned before, the value of a bond is found at the present value of an annuity, the interest payments, plus the present value of the principal. This is the equation of an annual coupon bond valuation, where N equals dollars of interest paid each year equals coupon rate par value. ROT equals the bond's required rate of return. M equals par value of the bond. N equals number of years before the bond matures for bonds that pay interest semi-annually. We must modify the valuation model as follows. First, divide the annual coupon interest payment by 2 to determine the dollars of interest paid every 6 months. Second, multiply the years to maturity, N, by 2 to determine the number of semi-annual periods. And finally, divide the nominal quoted interest rate, ROT, by 2 to determine the periodic semi-annual interest rate. Okay, now, you knew the higher the bond's value, the more amount an investor will receive at maturity date. Next, we will explore which factors can make bond value fluctuate over time. If the coupon rate is set equal to the going rate of interest, which means ROT, when a bond is issued, the bond will be sold at par value. If interest rate rises above the coupon rate, a fixed rate bond's price will fall below its par value. Such a bond is called a discount bond. Over time, the bond's value will increase, leading to an upward sloping curve. Hence, the investor can receive a higher amount at maturity than the amount he paid for the bond. And vice versa, whenever the interest rate falls below the coupon rate, a fixed rate bond's price will rise above its par value. Such a bond is called a premium bond. Over time, the bond's value decreases, causing an upward sloping curve. Holding this kind of bond may reduce the amount you will receive at maturity. From all of this, we can summarize 3 types of bonds on one illustration chart. As we can easily see, the curve of bonds price is affected by changes in interest rate. In addition, remember back to the formula of bond valuation, with any coupon payment bond, either premium or discount bond. When interest rate increases, price of bond will decrease and vice versa. Besides that, we also have some notes to pay attention. 1. The bond price is inversely related to the market discount rate. When the market discount rate increases, the bond price decreases, the inverse effect. It's very important to notice market discount rate because this will directly affect bond's price and resale of bond. So in this case, which kind of investor will not be negatively affected from buying bond? That's the investors buying bonds and hold till maturity too, for the same coupon rate and time to maturity. The percentage price change is greater in absolute value, meaning without regard to the sign of the change when the market discount rate goes down than when it goes up, the convexity effect. And that's all about bonds price being affected by interest rate. How about the coupon payment, which investors receive at the end of each period? The answer is coupon payment is affected by interest rate too. Why? Because when investors receive coupon payment, they will reinvest with new interest rate. If interest rate increases, then they can profit in the next period. If interest rate decreases, investors will receive less than the original amount. So we can come to the second conclusion: when interest rates increase, bond prices will decrease, coupons payment increase. And when interest rate decrease, bond price increase, coupon payment will decrease. Until now, we get to know the definition of bond. 5 key characteristics of it, how to value bond and how it changes over time. So what metrics can be used to measure the risk of increase or decrease in interest rate? We will discover in the following part.
In this part, I will talk about different type of risk. We have 3 main types: inflation, default, maturity risk. There are many more, but we can only stress on these 3. Talking about the inflation, it has a major effect on interest rate because it can erode the purchasing power of currency and lower real rate of return. Here's the formula that we have learned in Principle of Economics. The second type risk is default risk. So what is this risk? This is the chance that a company or individual will be unable to make a required payment. Hence, a greater default risk, the higher bond due to maturity. Uh, there are many ways to control or mitigate this risk. We have an indenture, is a legal document that governs the right of both bondholders and issuing corporation. The second, in this section, we have a negative covenant is an agreement that restricts a company from doing certain actions, and the opposite of it will be the positive covenant, a promise to do something. A common example is to have to build a and maintain a fence, contribute to the maintenance of equipment, etc. Risk, I can only give a short introduction into its characteristic because of time restraint. So the first characteristic is long-term bonds heavily exposed to interest rate risk. The interest rate risk can stand for the price risk, the decrease or increase in bond price caused by a rise or fall in interest rate. The short-term bills heavily exposed to reinvestment rate risk. This is the risk that a decline in interest rate will lead to a lower income when bonds mature and hence will create a lower reinvested amount. Um, the second thing is people or firms who invest in bonds are exposed to risk from changing interest rate, or we can say interest rate risk. The longer the maturity of the bond, the greater the exposure to interest rate risk. To induce an investor to take extra risk, long-term bonds must have a higher expected rate of return than short-term bonds. This additional return is the maturity risk premium.
The term structure of interest rates is the relationship between long and short-term rates. The plot of interest rates at different maturities is called a yield curve. By drawing successfully a yield curve, interest rate at each time maturity can be extracted. It helps predict interest rate 1 year from now. shape of yield curve depends on expected inflation rates and perceptions about the relative riskiness securities with different maturities. The normal yield curve is upward sloping because investors charge high rates on long-term bonds even when inflation is expected to remain constant. Long-term bonds have more interest risk than short-term. An inverted, or downward sloping, yield curve signifies that investors expect inflation to decrease. These bonds used for bootstrapping the yield curve are called term structure, presumably have the same currency, credit risk, liquidity, and tax status. Most importantly, they have no coupon reinvestment risk because there are no coupons to reinvest. They are all zero coupon bond. This is an example of government bond yield curve. From the curve, we can answer such question: if the government plans to issue new one-year bond in the next 1 year, how much YTM it gonna have? Normally, the curve is the basis for us to calculating forward rate with no arbitrage method.
As I said earlier, we have bond price sensitive to int rate. Now this the time for measuring it. We use duration. So, what is duration? Duration is the sensitivity of the bond's full price, including accrued interest, to change in bonds yield to maturity or to change in benchmark interest rates. It is also the weighted average of the times until those fixed cash flows are received. When the price of an asset is considered as a function of yield. First, look at Macaulay duration. The Macaulay duration is the weighted average term to maturity of the cash flows from a bond where the weight is the percentage of the present value of the cash flow with respect to the sum of the present value of all cash flows. In the formula here, this is the sum of the present value of all cash flows divided by current bond price or the present value of the cash flow. The next duration I want to introduce you is modified duration. Modified duration is a formula that expresses the measurable change in the value of a security in response to a change in interest rates. The modified duration is an adjusted version of the Macaulay duration, which accounts for changing yield to maturities. The formula for the modified duration is the value of the Macaulay duration divided by 1, plus the yield to maturity, divided by the number of coupon periods per year. It means that the modified duration determines the changes in a bond's duration and price for each percentage change in the yield to maturity. The last duration I want to mention is effective duration. The effective duration is defined as the sensitivity of a bond's price against a change in a benchmark yield curve. The effective duration is an essential measure of interest rate risk for complex bonds, such as bonds with embedded options. Embedded option is function that allows holders or issuers of financial securities to take specified action against one another in the future, for example, have the option to pay off the principal value of their loans, in whole or in part, at any time, such as callable bond or mortgage-backed bond. About callable bond. The duration of a callable bond is not the sensitivity of the bond price to a change in yield to worst. Callable bonds do not have a well-defined internal rate of return, yield to maturity, and yield duration statistics such as modified and Macaulay durations do not apply. So, the effective duration is the appropriate duration measure. About mortgage-backed bonds. Mortgage-backed bonds have a prepayment option, which accelerate when interest rates fall significantly because borrowers can refinance their home loans at a lower rate and pay off the remaining principal owned in an existing loan. With the fact that bonds with embedded options have uncertain future cash flows, the future cash flows depend not only on future interest rates but also on the path that interest rates take over time. Means that our present value calculations for bond value based on YTM cannot be used, modified and Macaulay durations. Therefore, we must use effective duration to estimate the interest rate risk of these bonds because unlike modified duration, effective duration does not necessarily provide better estimates of bond prices for smaller changes in yield. Unfortunately, duration has limitations when used as a measure of interest rate sensitivity. while the statistic calculates a linear relationship between price and yield changes in bonds. In reality, the relationship between the changes in price and yield is curve. The relationship between the bond price and yield to maturity is a curved. Hence, duration measures are merely estimates, not the exact calculation for the changes in price. When yields decrease, the estimate price change will be less than the actual price change, thereby underestimating the actual price. When yields increase, the estimate price change will be greater than the actual price change, thereby overestimating the actual price. In the image below, the curved line represents the change in prices given a change in yields. The straight line tangent to the curve represents the estimated change in price via the duration statistic. The shaded area reveals the difference between the duration estimate and the actual price movement. As indicated, the larger the change in interest rates, the larger the error in estimating the price change of the bond. From that, we can get the sense of how wrong using only the approximate duration. Now I want to introduce you about convexity. Convexity builds on the concept of duration by measuring the sensitivity of the duration of a bond as yields change. Convexity is a better measure of interest rate risk concerning bond duration. Where duration assumes that interest rates and bond prices have a linear relationship, convexity allows for other factors and produces a slope. Bonds' convexity can be estimated as this formula. Convexity demonstrates how the duration of a bond changes as the interest rate changes. If a bond's duration increases as yields increase, the bond is said to have negative convexity. If a bond's duration rises and yields fall, the bond is said to have positive convexity.